There's a story from 1999 that most people have forgotten. A company called Pets. Company raised $82 million, went public in February of 2000, and by November of that same year, less than 9 months later, it was completely gone. Not struggling, not cutting staff, gone. The stock had fallen 98%. Now here's the strange part. The people who lost money in Pets.com weren't foolish people. Many of them were intelligent, educated, experienced investors. They weren't chasing a scam. They genuinely believed they were buying the future. So what went wrong? The answer to that question isn't really about Pets.com. It's about something much older and much more dangerous than any single company. And understanding it might be the most important thing you do for your money this year. Because right now, a very similar story is playing out with a company most people consider exciting, innovative, and almost impossible to bet against. And by the time we're done today, you won't just understand what's happening, you'll understand why it was always going to happen. And more importantly, what the calm, patient, experienced investor does when everyone else is either panicking or celebrating too early. When a new company goes public, when it lists its shares on the stock market for ordinary people to buy, there's a ceremony to it. Bells ring, champagne is poured, the headlines are glowing, and for a few days, sometimes a few weeks, everything looks wonderful. But there's a quiet reality underneath all that celebration that most people never learn about until it's too late. New listings are, almost by design, priced to benefit the sellers, not the buyers. The people who owned shares before the public ever got involved, they needed an exit. And the public offering is that exit. Now, this doesn't mean every company that goes public is a bad investment. Some of the greatest businesses in history started as public offerings. But there's a well-worn pattern, one that repeats with almost clockwork regularity. And if you can learn to recognize it, you'll stop being the person who buys at the top and wonders what happened. The pattern goes like this. The stock launches, it surges, excitement builds, ordinary investors pile in, and then quietly, the early money begins to leave. Not all at once, slowly, methodically, and the stock drifts lower, sometimes much lower, before anything resembling a real opportunity appears. Today we're looking at a company that's right in the middle of that pattern. And what makes this particular story worth understanding deeply isn't just the company itself, it's the entire environment surrounding it. Because this isn't just about one stock going up and down. There's a much bigger conversation happening underneath the surface about artificial intelligence, about interest rates, about how institutional money thinks, and about one of the most important psychological traps that investors keep falling into, generation after generation. Let's start at the beginning. My grandfather used to say that the price of a thing and the value of a thing are two entirely different conversations. He'd use the example of his neighbor's old truck. The neighbor had painted it a bright red color, polished it until it gleamed, and put it at the end of the driveway with a handwritten price tag that would have bought you two perfectly good trucks elsewhere. And for a while people slowed down to look. Some of them even asked questions, but nobody bought it at that price. Because underneath the shiny coat of paint, the engine needed work, the frame had rust, and the mileage told a different story than the appearance. The stock market is no different. When a company goes public at a very high valuation, and I mean eye-wateringly high, like paying for a harvest that hasn't been planted yet, you're not buying the business as it is today. You're buying a promise about what it might become. And the question a careful investor always asks is, what exactly has to go right for this price to make sense? In this case, the company in question was priced at roughly 100 times its annual revenue. Not earnings, revenue. That's the total money coming in before a single expense is paid. Before salaries, before equipment, before debt, before anything. Think about that the way a farmer thinks about seed. If I plant one seed and I expect to harvest 100, I'd better be very, very sure that the soil is right, the rain will come, and nothing unexpected eats the crop along the way. Because if any one of those things goes wrong, I've planned my entire season around a number that was never realistic. That's what 100 times revenue looks like. You need extraordinary, sustained, almost perfect growth just to justify the starting price before anything goes wrong. And things went wrong. Here's where most people make a mistake. They look at a falling stock and they think, what did that company do wrong? But that's the wrong question. Or at least, it's only half the question. The smarter question is, what environment did that company fall into? Imagine a man trying to row a boat upstream. Even if he's strong, even if he's skilled, even if the boat is well built, if the current is against him hard enough, he's not going anywhere. Maybe he goes backward. And if someone standing on the shore only sees him struggling, they might assume it's his fault. But the experienced observer looks at the river first. Two things happened that very few people connected in the way they should have. First, a broad sell-off in technology companies. Chip makers, cloud businesses, large platform companies, they all came under pressure within a very short period. Billions of dollars moved out of these sectors in just a few days. When money leaves an entire industry like that, it doesn't leave gently, it floods the exits. And the most expensive things in the room get discounted the hardest, because the gap between their price and their underlying business reality is the widest. Second, and this is the one that carries real weight, there was a crack appearing in the artificial intelligence story. Not a collapse, a crack. But on Wall Street, a crack in a high-conviction narrative is enough to make institutional money very, very nervous. Two of the most respected AI researchers in the world departed from one of the largest technology companies, publicly suggesting that the organization was too slow, too bureaucratic, too constrained to reach the next frontier of what artificial intelligence can actually do. Now, to most people reading a headline, that sounds like internal drama. To an institutional investor, it sounded like something else entirely, a signal that the AI race might not go the way everyone assumed. And this matters enormously for our story, because the company we're discussing had quietly transformed itself. It was no longer primarily what most people thought it was. It had pivoted its core business towards selling computing infrastructure to artificial intelligence companies, data centers, cloud capacity, the pipes and power lines of the AI economy. Which means if the AI story gets complicated, if the spending slows, if the promise gets questioned, then the business model that's supposed to justify a 100 times revenue valuation gets questioned right along with it. The boat was already fighting the current, then the current got stronger. This situation has a cousin in history, and it's worth spending a moment there, because the parallels are uncomfortable in the best possible way. In the late 1990s, there was a period where the internet was correctly identified as a genuinely transformative technology. This wasn't delusion. The people buying technology stocks weren't wrong about the technology. They were wrong about the timeline, the valuations, and who specifically would win. Companies were funded, listed, and celebrated, not because they had profitable businesses, but because they were adjacent to something real. Being near the internet was enough. And for a while, the market rewarded proximity over profit. A company selling pet food online was worth more than actual profitable retailers with decades of history, simply because it existed in the new world. What eventually happened was not that the internet turned out to be unimportant. Quite the opposite. The internet turned out to be every bit as transformative as advertised. But the correction came anyway, and it was severe, because the prices had sprinted so far ahead of the underlying reality that even a slight questioning of the pace of change was enough to trigger a collapse in valuations. The lesson wasn't technology is dangerous. The lesson was the right technology at the wrong price, in the wrong environment, with the wrong amount of debt and the wrong amount of patience can still cost you dearly. We are in an AI moment that rhymes with that internet moment. Artificial intelligence is almost certainly a genuinely transformative technology. But there is a canyon-wide gap between this technology will change the world and this specific company, at this specific price, is a wise investment right now. The dot-com era taught us that gap can remain open for a very long time and can close violently before the underlying technology proves out. There's one more piece of this that the financial news covers but rarely explains in plain terms. So let me try. When interest rates are low, when borrowing is cheap, something interesting happens to how investors value the future. They're willing to pay a lot today for money they expect to receive years from now because waiting costs them very little. Think of it like storing grain. If storage is free, you're happy to set aside grain today that won't be eaten for 5 years. But when interest rates are high, when money sitting idle actually earns a return, the future becomes less valuable relative to today. That same grain in storage is now costing you something. And so you become much more careful about how much you pay now for harvests that are years away. High-growth, high-valuation companies, the kind trading at 100 times revenue, are essentially asking investors to pay an enormous amount today for earnings that might not arrive for 5, 7, 10 years. In a low-interest environment, that's a calculation some investors are willing to make. In a high-interest environment, the math falls apart quickly, and right now, we are in an environment where interest rates have stayed higher than many people expected, where inflation has remained stubborn, and where the expectation of rate cuts keeps getting pushed further into the future. For a company priced on optimism, on future potential, on a story about what it might become, that environment is genuinely hostile. Every month that rates stay high, the present value of those future earnings gets a little smaller. The most expensive things in the market feel that pressure first and feel it most. When experienced investors look at a situation like this, they don't ask, is this company good or bad? That's a beginner's question. The question they ask is, what is the market currently pricing in, and is the market right? And right now, there's a fascinating tension. Some investors look at the largest, most established technology companies, the ones with real revenue, real profits, real cash generation, and they see stocks that are priced as if the AI era is ending before it truly began. These companies have massive data center contracts, growing revenue, and yet their valuations have been compressed. Some investors believe this is a mispricing, that the market is being too fearful about near-term uncertainty while missing the long-term trajectory. Others look at the smaller, more speculative names, companies with thinner business foundations but enormous growth ambitions, and see valuations that suggest the AI era is still perfectly on track for another decade of expansion. These two pictures exist simultaneously in the same market. What that tells you is something important. The market is genuinely uncertain. It doesn't have a consensus, and when the market doesn't have a consensus, volatility tends to persist. Some investors argue this uncertainty is exactly when the best long-term opportunities are created. They're not wrong. When no one can agree on what something is worth, prices can become disconnected from reality in both directions, too high for the hype names and sometimes too low for the solid ones. Others argue that in uncertain environments, patience is the strategy, waiting for clarity before committing significant capital to high-risk positions. They're not wrong either. The important lesson isn't which camp is right, it's that both camps exist for reasonable reasons, and the investor who understands both perspectives can navigate with far more calm than the one who's simply reacting to yesterday's price movement. So what does the thoughtful long-term investor actually do with all of this? A few things worth sitting with. The first is to understand what you actually own. This sounds obvious, but it's rarer than it should be. Many people who held this company thought they were invested in one kind of business when the company had quietly transformed itself into something quite different. Before you own a stock, you should be able to explain, in plain language, how it makes money today, not in 5 years, not eventually, not if everything goes right, today. The second is to ask yourself how much of your portfolio is betting on a single story. If the AI spending boom continues uninterrupted, some portfolios will do very well. But what happens to those portfolios if the AI story pauses for 6 months or 12? Concentration isn't always a mistake, but concentrated bets on uncertain narratives in a high interest rate environment deserves a very honest conversation with yourself about risk. The third is to separate the technology from the valuation. The technology may be real and important. That doesn't mean every company participating in that technology is priced appropriately. There's a meaningful difference between believing in electricity and paying 10 times the fair price for a power company. And the fourth, perhaps the most important, is to be very skeptical of the emotional arc that comes with new public offerings. The excitement is real. The gains in the first days can feel like confirmation. But a stock going up quickly after listing doesn't tell you anything about whether the price is justified. It tells you that demand temporarily exceeded supply in a moment of peak enthusiasm. Those two things are different. The pattern of euphoria followed by disappointment, followed by a long quiet period, followed by genuine opportunity. It has repeated in markets for as long as markets have existed. Knowing that pattern doesn't make it emotionally easy to navigate, but it makes it navigable. There's a phrase I keep coming back to in moments like this one. Price is what someone is willing to pay on a given day. Value is what something is actually worth over time. And the gap between those two things, that gap is where both mistakes and opportunities live. The investor who confuses a rising price for rising value will always be surprised when they diverge. And they always diverge eventually. The investor who learns to evaluate value independently, who can look at a business and form a view about what it's worth without being carried away by what others are currently paying for it. That investor doesn't need to predict the market. She just needs to wait for moments when the price comes to meet the value. And those moments always come. This isn't a gift you're born with. It's a skill you develop slowly, the same way a farmer develops an eye for soil quality. You get better at it by studying quietly, making mistakes modestly, and refusing to let the noise of the market become the voice in your head. The market will always be offering something exciting. It will always be generating fear about something worrying. That's its nature. The question is whether you're learning to think more clearly every year, or simply becoming more reactive. Let's bring this full circle. A company went public. It surged. Then it gave everything back. And the reasons weren't mysterious once you understood them. An extraordinary valuation built on an uncertain narrative, inside an industry facing genuine philosophical questions, inside a broader economy where money has a cost. None of that is cause for panic. But none of it is cause for dismissal either. The lesson here isn't don't invest in new companies, or technology is risky, or stay in cash. The lesson is much simpler than that. Know what you own. Understand what price you're paying and why. Build a portfolio that can handle being wrong about something without it becoming a crisis. And give yourself enough time for good businesses to prove themselves, because they do, eventually, when they're bought at sensible prices. The market rewards patience far more reliably than it rewards excitement. That's what decades of investing eventually teaches you. And the beautiful thing is, you don't need decades to start applying it. You just need to be willing to slow down, think carefully, and value wisdom over noise. If that kind of thinking resonates with you, the slow, calm, long-view approach to building real financial understanding, then you're in the right place. Subscribe to Grandpa's Finance Class. Not because we'll tell you what to buy, but because we'll keep working together on the kind of thinking that makes every financial decision a little clearer. We'll see you in the next lesson.